to the Global View on this Thursday. Well, US manufactured goods fell more than expected in October as orders for cars and parts dropped amid strikes by vehicle manufacturing workers. This combined with a slowdown in CapEx investment, suggesting to economists that underlying momentum in the US economy is beginning to fade. US consumer inflation expectations over the next year rose for a second straight month in November to 4.5%, despite signs of a slowing price increases there. And jobless claims fell more than expected last week, dropping to a seasonally adjusted 209,000, the lowest level in more than a month. Jobless data helping a rebound in Treasury yields as the futures market lowered the likelihood of a rate cut by early next year. The yield on the 10-year note rising to 4.43% and the 2-year up to 4.93%. And the US dollar rebounded from a 2.5-month low, while the British pound snapped recent gains after UK Finance Minister Jeremy Hunt announced tax cuts for workers before next year's election. The Aussie dollar currently trading at 65.4 US cents. Well, a Reuters poll forecasts most key global stock indices to rise modestly over the coming year, closing 2024 below record highs. The benchmark US S&P 500 forecast to finish next year at 4,700, about 2.5% higher than its current level. The Pan-European STOXX 600 forecast to rise around 4%, while Japan's Nikkei 225 and India's BSE both expected to continue their strong performance into the next year, with the Nikkei forecast to reach a 3-decade high of 35,000 by June, and the BSE forecast to hit a new high in 2024. Well, to discuss the outlook and the status of corporate India, we're now joined by Gunther Siva from India Avenue Investment. Gunther, good to see you.
Likewise.
Do you agree with perhaps that forecast of where Indian stocks could go next year?
Yeah, look, I think since COVID, we've seen a run rate of earnings of about 20 to 25% per annum. That run rate will no doubt slow because the base is now shifted, but we're still expecting in the vicinity of 10 to 15% earnings growth.
All right, so as I mentioned there, you're looking at the outlook, I guess, for corporate India, you're saying potentially it could benefit from operating leverage. What are you seeing here?
So I think for the, since I've been looking at India going back over 25 years, from a corporate perspective, debt to equity has hit an all-time low. So we're talking debt to equity levels below 0.6. And corporate India really spent the 10 years before COVID deleveraging from a previous cycle high. So we're now at a point where leverage is low. Interest rates in India haven't really moved the dial over the last 15 years. So corporates aren't paying any more than what they used to. Capacity utilization is at about 0.8. So there's opportunity to push that up to 1. And the operating leverage that can be gained from increasing market share of the global economy can be significant from this point. Low level of debt on the balance sheet, average interest rates.
What's the prediction for where those interest rates are going to go then?
I think India's cash rate is 6.5%. 10-year bond yields are somewhere around 7.5%. Inflation is running at 5% at the moment. So there's probably scope to cut rates, but the concern would be global rates rising above Indian rates, which is unheard of.
So your point is that the economy has room there, or capacity to be added at this point?
Capacity to be added and potential to serve the rest of the world. I think when I look at India, I see 20% of the population where incomes are growing strongly, and that reflects the US economy part of India. That's 280 million people. The other 80% incomes aren't growing as strongly, and they're set to really benefit from the operating leverage of India winning market share, lower cost of labor, and basically rising up the GDP per capita curve.
How do that lower cost base compare with other emerging markets?
Markets like Vietnam, Bangladesh, Indonesia also have low cost advantages, but their economies and their scale is at a different level to India. We read a couple of days ago that Tesla is looking to build a facility in India, for example. So part of that will leverage on the 300 million consumers that have got a higher GDP per capita, build scale, and the other part leverages on the low cost factory structure. So you've got the two things working for you, whereas some of the other markets are pure low cost.
How does that compare with China? I mean, you use Tesla as an example. Clearly they've got the presence in China, building one in India to serve both populations, but also perhaps in terms of exports as well. How does India stack up then?
Yeah, so India will never be a China from a manufacturing perspective. It just doesn't have the scale, and it's not on the same capacity. Urbanization levels are still about 35%, which is well below China and most other emerging markets. So that pickup in scale is yet to come. But I think one of the benefits from India is already has a fairly sizable consuming population.
Well, in fact, to that point of domestic consumption, given that rapid rise in population, and once again, I guess making that comparison with China, which is the population growth there stagnating essentially, whereas India is moving ahead very quickly.
Correct. So if you look at GDP per capita, then 16 years ago, India is now where China was back then. But the rate of increase should be much higher going forward for India compared to China, because China has already pushed well past the 10,000 GDP per capita.
So Mugunthan, that said, how does an investor take advantage of this?
Look, there's two ways really. There's local consumption through banks and financials, companies like that are playing on increasing consumption, increasing penetration of digitization, increasing penetration of insurance. For example, insurance penetration in India is 1%. So there's a long way to go. So you could play that part of the economy, or you could play winning global market share using labor cost advantage. We talked about pharmaceuticals a lot on this show. That's where India is becoming an increasing exporter to the rest of the world and will benefit from that low cost advantage.
Well, good. Thanks for joining us from India Avenue Investment Management.
Thanks, Andrew.
All right, that is the global view on this Thursday. Just a quick check of the market. Look, we are expected to open lower when we get going in just a couple of minutes' time. Yeah, SPY futures off 0.25% at this point. Stay with us. The open is next.